How does market efficiency impact your investment market risk? Imagine trying to beat the market by guessing which stocks will rise next. If markets are efficient, your guesses are less likely to pay off. Market efficiency is about how quickly and fully asset prices reflected all available information. When markets are efficient, prices are considered fair estimates of what investments are truly worth at any moment. This idea has a big effect on the risk you face as an investor. In an efficient market, because prices already include all known information, it's tough to find undervalued or overvalued stocks. That means trying to pick winners or time the market usually doesn't work well. If you want higher returns, you often have to accept higher risks. So, market efficiency links the expected returns you might get with the level of risk you take on. There are three main types of market efficiency. The first is weak efficiency. Here, prices reflected all past trading data like historical prices and trading volumes. This means studying past prices to predict future movements isn't very effective. The second is semi-strong efficiency. Prices reflected all publicly available information, such as financial reports and news. So, analyzing a company's financials or recent news doesn't give you a consistent edge. The third is strong efficiency. Prices include all information, public and private. Even insider knowledge can't help you beat the market in this case. Understanding these types helps when building your investment plan. If markets are efficient, passive strategies like buying index funds tend to outperform active management after fees and costs. Since prices adjust quickly to new information, trying to beat the market through frequent trading or stock picking involves taking on extra risk without guaranteed gains. When markets are efficient, the main risk you face is systematic risk. This is the risk that affects the entire market, like economic downturns or political instability. Because prices already reflected available information, unsystematic risk specific to individual companies, becomes less relevant. Diversification can help reduce unsystematic risk, but it can't eliminate systematic risk. This means you should focus on understanding your own risk tolerance and set realistic goals. Diversify your investments across different sectors and asset classes to manage risk better. Accept that taking on some market risk is necessary if you want to earn returns above the risk-free rate. Keep an eye on how efficient the markets are, especially in emerging or less developed markets, where information gaps might offer more opportunities but also come with higher risks. In the end, market efficiency shapes how much risk you need to take to reach your investment goals. It reminds us that trying to outsmart the market often involves accepting more risk, and that a balanced, diversified approach aligned with your comfort level is usually the best way to go.